the next step in the due diligence process is looking at the financials. Now, being an accountant, of course, this is my favorite step, but we will do an overview, really getting into the details of how to do financial analysis is a whole different training series. But here are the things that you want to be looking at when you're doing your financial analysis. First of all, do they have a business plan? That's number one. And if they do, hopefully, you're going to look at that business plan. And what's in the business plan? I mean, you can really take a big picture view of, does it even make sense overall? And then you can start looking at more details within the business plan. Now, if they don't have a business plan, you may want to gently suggest they create one. As well, when you're starting to look at the financial information, there's basically two pieces of information you should be receiving. One is, what have they done so far? And the other is, where are they headed? So where are they headed are projections, and projections are guesses. They are not guaranteed by any means. And so you really want to do some due diligence on the projections. You want to look at, are their projections aggressive, or are they really conservative, or are they somewhere in the middle? And you may even receive multiple projections doing different scenarios like that. Within the projections, particularly if you're considering an investment in a startup business, you want to look at, when do sales begin in this business? The sooner sales begin, the lower the risk is for the company. The longer the startup phase before income starts coming in, the bigger risk there is for the company getting off the ground successfully. As well, when you're looking at where sales begin, you want to look at, what are the sources of sales? Is everything coming from one place? Do they have diversified sources of sales? And what kind of marketing structure is underneath those sales? Sales don't come out of thin air. There's a lot of work that goes into making them happen, and the marketing plan goes hand in hand with the sales plan. Now, whenever you're looking at projections, because they are guesses, they are based on assumptions. And assumptions are some of the most important details to look at when you're reviewing financial information. So looking if your payback schedule in this potential investment really relies on sales growth, then you want to really understand the underlying assumptions that they have made regarding their sales growth, and check it out with yourself. Do you agree with those assumptions? Do they make sense? I mean, part of that is checking, maybe looking at the industry or other similar businesses, but part of it is just an intuition check. Does this make common sense to me that the assumptions underlying those projections make sense? Another really key number to be looking at in financial analysis is the break-even point. Every company has a break-even point. How many widgets do they need to sell to cover their costs? Or how many customers do they need to have on a daily basis to be covering costs? And it's not just the cost of operations, it's also the cost of servicing debt and any other investments that are made in the company. So the break-even point is really important. And again, looking at that great break-even point, there are going to be some assumptions underlying that break-even point. Now, some businesses you're looking at may have already passed their break-even point and they're profitable. Other investments you're looking at may be prior to meeting their break-even point. So that's also an important factor in the financial analysis of, where are you in the timeline of the growth of this business. There are different risks to each stage of development for a business. Next, you're going to look at, in their financial projections, how do the sales grow over time in relation to how the expenses grow over time. It's normal to have expenses growing with income, but it's also important that they grow in relation to income in a way that makes financial sense, i.e. makes profit on the bottom line, sooner or later, depending on the business plan. So you'll want to look at their projections, not only of sales projections, but also expense projections, profit projections, and finally cash flow projections. Now, this is a distinction that's really important, but it's hard for a lot of people to wrap their brain around, and that is the difference between a business generating profit and a business generating cash. Now, when I was in college, I took an entrepreneurial class, and one of the things we did is create a business plan. And I remember the very first day of that class, my professor, who had been consulting with small business for 30 years, she said, if you learn nothing else from this class, learn that in small business, cash is king. The only way you're going to get paid back on your investment is if the business is generating cash. regardless of their level of profitability. So it's important that when you're looking at projections, you're looking at how profit is going to vary over time, as well as how their cash flow is going to vary over time. Two very different projections. Another piece to look at in the financial analysis is particularly when you're looking at an investment in a company, a small business, or even a larger business, is the relationship of how much debt is in the business versus how much equity is in the business. And this is also going to vary depending on what kind of investment you're considering. If you're considering an equity investment or a debt investment with the deal. Again, there are pros and cons to both. They're both kind of different animals. They're really different types of investments, and there are different expectations that go along with them. Different levels of risk, different potential returns. And so you want to look at not only how that lines up for you and your money rules, but also what's the overall capital structure of the company. How much debt versus equity are they using to capitalize the company? And what does that mean for the company's success as well as your investment success? Now, finally, there's a set of tools that are going to be really helpful in doing your financial analysis. And as you use these tools, the number one tool is your team. Having somebody who's experienced in reading financial information and who also has the experience to help you understand that financial information is going to be an incredibly valuable tool for you to have on your team. So the core financial analysis tools that you should be receiving when you're looking at an investment are financial statements. What do the historical financial statements look like, and what are the projected financial statements look like? And the three primary financial statements are a profit and loss statement. This shows the inflows and outflows of the operations of the business. A balance sheet, it's going to show you a snapshot of assets, what they own, liabilities, what they owe, and equity, the ownership structure of the business. And finally, some kind of cash flow statement. Now, there are official accounting versions of cash flow statements that actually don't give you as an investor very much information, but a cash flow schedule or projection or worksheet is really going to give you a picture of how cash is flowing in and out of the business. So those are the three primary financial statements, both historical, what have they done, and projected, where are they headed. And then when you have those financial statements, the last tool that you have in understanding those is how they relate to each other. And there's a whole set of financial statement ratios that can help give you more information, more of the story of what's happening with a business financially. There are ratios to help explain, how well the business is paying its bills, how easy it is for it to generate cash, how much risk is embedded in the capital structure of the business, what kind of return the business is generating for its debt holders and its equity holders, how quickly it's collecting from sales, and so forth. There's a lot of different pieces of information that will come out of the financial statements when you learn how to apply ratio analysis and learn how to read those financial statements. So these are the steps that you're going to go through in a financial analysis process in the due diligence process. It's really easy for folks who are newer to direct investing to kind of gloss over this section, to look, are they making money? Are they planning to make money? Are they planning to generate cash? Okay, good, I'm on board. And there's really a lot more to look here. And that's why I said your very first tool in this step of the process is your team. This is an area where a trusted advisor can be invaluable to you. And whether it's an advisor or mentor that works with you for their own value, or if you're paying somebody to help you with this step, it is dollars very well spent for you, because it can save you thousands in making decisions around what fits for your money rules and your money goals.